In this module, we will review the math behind expected monetary value, a tool and technique to perform quantitative risk analysis. The purpose of using expected monetary value is to predict the value of an event which we have deemed to be uncertain. Since the occurrence and/or impacts of each risk are unknown, it is impossible to calculate the exact value that risk currently presents the project. We must rely on historical data and estimating techniques in order to create a model to attempt to predict the value of each risk. While real-life models can be quite complex, the formula for expected monetary value is composed of the two most basic elements that form our understanding of an uncertain event. The formula for expected monetary value is simply the probability or likelihood that an event will occur, multiplied by the anticipated impact of the event to the project if it occurs. While the probability will always be represented as a percentage of likelihood, the financial impact can be represented as either a negative number, indicating a loss to the project caused by a threat, or a positive number, indicating a gain to the project caused by an opportunity. We can see robust models for uncertainty in our day-to-day lives that use the concept of expected monetary value as the root of their mathematics. For example, when getting a quote for automobile insurance, the provider will ask you a series of questions to determine how likely you are to be involved in an accident: your age, gender, and driving history. They will also ask you questions to estimate the costs of such an accident, your location, and the type of car you drive. This information will be used to assess the risk you pose to their company, and a premium will be determined that allows them profitability. It is worth noting that the acronym for expected monetary value, EMV, should not be confused with the acronym for Earned Value Management, EVM. Let's try a couple of examples together. We will review one example together, and then you can attempt two on your own. After purchasing a new appliance for $3,000, the store manager asks you if you would like to add a 3-year extended warranty for $100. Using your best judgment, you guess that there is a 15% chance that the product will have an issue during the covered period, and that the average repair or replacement fee would be $500. The formula for expected monetary value is simply the probability of occurrence multiplied by the impact on the project objectives. In this example, the probability of failure is 15% and the average impact is negative $500. Using the formula, we can calculate the expected monetary value as negative $75. This simple model has estimated the value of the risk at negative $75 as compared to the cost of the warranty, which would cost $100. So do you buy the insurance? If you were to base your decisions on numbers alone, as you should on the exam, then you should not buy the warranty. The real answer may depend on your risk tolerance. Those that are risk tolerant will likely not buy the warranty, while those that are risk averse may be willing to buy the warranty for peace of mind. In this example, try solving the problem on your own, then click Next to view the answer. You are managing a $20 million project. After conducting research, you find that there is an 8% chance of an earthquake disrupting your project. If the earthquake occurs, your project will suffer an estimated $1 million in material replacement and another $2 million in costly rework. What is the expected monetary value of the earthquake? After you have solved the problem, click Next to view the answer. The formula for expected monetary value is probability times impact. The probability of the event occurring is 8%, which can be represented mathematically as 0.08. The impact of the event occurrence would be a loss of $1 million in materials and a loss of $2 million in rework. This is a total loss of $3 million, which can be represented mathematically as negative $3 million. After performing the math, that gives us an expected monetary value of negative $240,000. When you are ready to try another example, click Next. Again, try solving the problem on your own, then click Next to view the answer. You are the risk owner for the identified risk of a new zoning change. You find that there is a 55% chance of the change passing. If the change occurs, your project will be able to expand, increasing profits by $7 million. However, you will be forced to conduct $2 million in rework. What is the expected monetary value of the zoning change? Click Next when you are ready to see the answer. The formula for expected monetary value is probability times impact. The probability of the event occurring is 55%, which can be represented mathematically as 0.55. The impact of the event occurrence would be a gain of $7 million in expansion and a loss of $2 million in rework. This is a total gain of $5 million, which can be represented mathematically as positive $5 million. After performing the math, that gives us an expected monetary value of positive $2,750,000. After practicing expected monetary value a few times, you should find the math quite easy. This technique is intended to show the most simple of models that can be used to quantify a risk in dollars. Remember to always consider if the risk event in question is a threat or opportunity and adjust your math accordingly, using negative values to represent losses to the project or threats. Unfortunately, the model driving risk is not always so simple. In the next module, we will practice using this concept with decision trees to solve more complicated scenarios.